ऐश्वर्यस्य विभूषणं सुजनता शौर्यस्य वाक्संयमो ज्ञानस्योपशमः श्रुतस्य विनयो वित्तस्य पात्रे व्ययः अक्रोधस्तपसक्षमा प्रभवितो धर्मस्य निर्व्याजता सर्वेषामपि सर्वकारणमिदं शीलं परं भूषणम् असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्योर्मामृतङ्गमय ॐ शान्ति शान्ति शान्तिः.
Now, considering the advent of multiple choice questions at the CA intermediate level as well as at the CA final level, students will have to be extremely careful in studies, especially in the coverage that you do. Previously, in the absence of multiple choice questions, when you had 60 marks and at some point in time there were 75 marks reserved for income tax, we could afford to have not covered one or two of the chapters in income tax. But with multiple choice questions coming in, there is very, very little scope for not covering any of the chapters, say intermediate level, because the examiner will have a wide choice of chapters to consider while framing a number of questions. Now take this, before it was hardly around 10 or 12 questions that were there as part of the income tax question paper. Now, because of these 1 mark and 2 mark multiple choice questions, the possibilities are quite immense. Therefore, even chapters such as TDS, TCS assume a lot of significance in this whole MCQ scenario. Now, the exams being in May and November, usually for the month of May, the concentration is more on the changes that have taken place by the Finance Act that is applicable. Now, for the information of everyone watching this telecast, the amendments change, or basically the income tax law changes with every year's budget. So in a particular year, when the budget is proposed by the finance minister on the first working day of the month of February, it is then discussed and passed by the parliament to be made into an act and is applicable to the immediately following previous year and the assessment year that is applicable. So for the present previous year, which is 2020-21, or the assessment year 2021-22, the amendments proposed by Finance Act 2020 are applicable. The amendments proposed in Finance Act 2020 are quite huge in number. There are, in fact, more than 100 amendments that are applicable for this particular Finance Act 2020. And because there are nearly 100 amendments, it again, or once again rather, gives the option for the examiner to choose from a very wide variety of changes that have taken place in income tax this particular year. So in the coming 90 minutes or so, we would be discussing about any of these changes that have taken place in income tax or that would be made applicable for the assessment year 2021-22. For the students who are writing exams in May 2021 and November 2021, the Finance Act applicable or the changes to the Income Tax Act are applicable with effect from Finance Act 2020. And the assessment year and the previous year that is applicable would be the previous year 2020-21 and the assessment year 2021-22. Because this is the first exam where the changes made by Finance Act 2020 are applicable, it is very, very important for the students to understand many of these changes that have taken place. Finance Bill 2020 and now Finance Act 2020 was the first full-fledged budget of this particular government. Of course, there was a budget that was presented in the month of July 2019, but this gave enough time for the finance minister as well as the government of India to think, plan, and introduce certain considered changes. And that is why the number of amendments are very high in number. I would specifically mention two amendments which are of utmost important at the CA intermediate level. You can even expect full-fledged questions on the changes in the rule of residence that has taken place uh, through Finance Act 2020, which is for Section 6, and the changes in the rates of taxes that have been introduced through the Section 115 BAC. These two are extremely important amendments to the extent that you can actually expect uh, the entire question to be dedicated on these amendments only. There are several other amendments that have also taken place, but out of these 100 odd amendments that have taken place, though at the CA final level, one has to remain abreast on each of these amendments. At the CA intermediate level, I do think that we can narrowly focus on maybe around 20-25 of these amendments that have taken place. So, considering that May exam is the first exam where Finance Act 2020 is applicable, one has to be 100% sure of the amendments that have taken place. Before I start my presentation, I would also like to draw your attention to the reference for quick revision PDF file which has been released by the Institute. It's an excellent file. Do download it from the Institute's website, which gives you a bird's eye view of the things that are applicable in income tax for the CA intermediate students. Reference for quick revision, it also has emphasis being laid on the amendments that have been introduced by Finance Act 2020. So do refer to this particular PDF guide that has been that is available for download in the institute's website. So having said that, let me start with the presentation, and I have divided each of these amendments, or rather all of the amendments, uh, chapter wise. I have considered the chapters that are available in the study material right from module 1, 2, and 3. There are three modules that are applicable to income tax, and I have divided these amendments chapter wise, so that you can understand the amendments in the context of the chapter that is discussed. And while discussing these amendments, I would also like to point out the original rule or the original law that was in place then, and what has been the change that has been introduced by Finance Act 2020. I hope the presentation is visible on the screen. And let me start with the changes that are applicable. So here we go. First, let us very quickly take you through all the changes that are applicable here. Let's start with module 1, basic concepts. Hardly anything that is there, though basic concepts chapter does discuss about some amendments. It obviously makes a reference to the the different chapters where these amendments are actually discussed in great detail. And then you have residence and scope of total income. The definition of resident, very important amendment this year, has changed. If you are already aware of it, great. If you are not aware of it, please ensure that you listen to the rest of the telecast very, very carefully, because it's a very, very important amendment, not just at the CA intermediate level, but also at the CA final level, and definitely in the world, this has got a lot of consequences. The third chapter in module 1 is incomes which do not form part of the total income. No amendments there. Module 2 on salaries. You have got the 5 heads of income that are discussed there in module 2. Section 17, there is a change. Income from house property, there is no change. Business or profession, there are a couple of changes. 44AB is a very important change. I will give you the explanation, but I do think that maybe 44AB amendments could be a hot shot question at CA final level. Capital gains, almost a certainty in every CA intermediate exam, a large problem rather on capital gains. 50C, a very important amendment has taken place. Slight change in the figures, but it has got uh, consequences. Section 55 has changed. Income from other sources, another landmark change where now they have brought to tax income from dividends, and at CA intermediate level where a question on computation of total income is once again a certainty as question number 1. You can expect questions to be asked on section 57 whereas section 154. Then you have income of other persons, clubbing provisions, no changes. Set off and carry forward of losses, no changes. Deductions from gross total income, to minor changes there, and then the big one, section 115 BAC, a lot of noise is made of this particular section, and I'm willing to bet that this particular section would be most likely multiple times at the C intermediate level. So everything about section 115 BAC an intermediate student should be aware of. Every part of this section, every word that is discussed there, every section that is quoted on section 115 BAC, you need to be aware of, and you could very well be uh, answering a question on section 115 BAC inside the first 5 minutes of your exam. Such is the importance of this particular section, not just at the CA intermediate level, also at the CA final level, and in the practical world, definitely while filing every person's income tax returns. Just imagine there are nearly 10 crore income tax returns that are filed. Every individual's income tax returns when they are filed, section 115 will be discussed. So I will not see will make strong case in the popularity charts in the next year. So we will discuss about 115 BAC in great detail later. The smaller sections, or rather the chapter which no one wants to study, advanced tax, TDS and TCS, because there are so many sections listed in this particular chapter. Almost many sections have undergone change. There is a very, very important change, which is like an umbrella change because of the whole pandemic situation last year that has taken place, where the government in one go had told that every TDS rate and TCS rate that is applicable, only 75% of the rate will be applicable from a particular date, 14th May 2020 to 5th March 2021. So you can definitely expect questions on this particular change, the 75% uh, of the rates applicable in TDS and TCS chapters. Be mindful of that, especially at the multiple choice questions now. There is one change at the returns of income as well. So these are some of the changes that we are going to discuss in the course of the next 1 hour or 1.5 hours or so. And to make it easy, and so that the students understand the context in which these sections have been amended, I have divided them chapter wise from your study menu. So let's start. Uh, let's start with the first change that has happened, which is section 6 of the. Now, this is being told to you in the context of the chapter on residence, rule of residence, and incidence of tax based on residence. This chapter was taken for granted because Section 6, Section 5, Section 7, and to some extent Section 9 are the easy sections at the CA intermediate level, though it's a completely different property when you go to the CA final level. There is a pretty easy section for most of the students. And in, I think, many cases, even the teachers would say that maybe questions will not be asked from this chapter because this is too easy a chapter. However, that has been a change. A change has taken place in Section 6 of the Income Tax Act. Now, before I discuss the change, let me point out what was the rule in the first place. What was the residential rule that was applicable to individuals? Now, one thing that I wanted to tell before, one reason why many of these changes are very important at the CA intermediate level is because questions at the intermediate level are usually focused on assessment or taxation of individuals and HGFs. And most of these amendments that I'm going to discuss in this PowerPoint are applicable to individuals and HGFs. Okay, and and this is one such amendment which is fully applicable to an individual. Now, what was the rule of residence applicable to an individual? An individual becomes a resident in India if he satisfies one of the following two conditions. An individual becomes a resident in India if he satisfies one of the following two conditions. Condition number one, you should stay in India for 182 days or more in the previous year. If you stay in India for 182 days or more in the previous year, you become a resident as per the income tax law. Or condition number two, you should stay in India for 60 days or more in the previous year and for 365 days or more in the 4 years preceding the previous year. If one of these two conditions are satisfied. Condition number one, the 182-day rule. Condition number two, 60 days in the previous year and 365 days in 4 years preceding the previous year. So two conditions there in condition number two. If one of these conditions are satisfied, then you become a resident in India under the income tax law. Further, you get down to understanding what is the meaning of an ordinarily resident and a not ordinarily resident. This has been the rule of residence ever since, for ages, ever since at least I started studying income tax, which is a good 20 years. So this has been the rule of residence, the settled law, until and unless Finance Act 2020 came into the picture and has brought in a new angle to this definition. Now, please understand this definition as such is not changed. The 182-day rule and the 60 plus 365-day rule, this has not been changed. It has remained the same. But they have added one more condition and have told that, see, in this case also, he becomes a resident. Now, to carry forward the initial definition of 182-day rule and the 60 plus 365-day rule, there was an addendum to this particular provision, which further said that in the following three cases, the 182-day rule is not applicable. What would be applicable is only the second rule, which is 60 plus 365-day rule. What are these three cases? Case number one, an Indian citizen who goes abroad for employment purposes. Case number two, an Indian citizen who leaves India as a member of the crew of an Indian ship. And case number three, an Indian citizen or a person of Indian origin who comes to India on a visit to India. In these three cases, we were told that the first rule, the 182-day rule, is not applicable, but what is applicable is only the 60 plus 365-day rule. Okay? Now, there has been an addition to this particular rule, which says that an Indian citizen or a person of Indian origin will also be treated as not ordinarily resident if these three conditions are satisfied. Condition number one, total income during the previous year, other than income from foreign sources, exceeds rupees 15 lakh, and we'll come to this particular point in a little later. Total income during the previous year, other than income from foreign sources, exceeds rupees 15 lakh. He has stayed in India for 365 days or more in the 4 years preceding the previous year. And number three, he stays in India during the previous year for 120 days or more. The 120-day rule has come into the picture through Finance Act 2020. The 120-day rule says that number one, you must be an Indian citizen or a person of Indian origin. Number two, your total income during the previous year exceeds rupees 15 lakh. Please note the words exceeds rupees 15 lakh. So a problem which says 15 lakh, this particular rule is not applicable. Total income other than income from foreign sources exceeds rupees 15 lakh. You stay in India for 365 days in the 4 years preceding the previous year, and you stay in India during the previous year for 120 days or more. Students, be very, very careful in understanding this amendment and see how can this be applied in a practical situation. One can anticipate a very simple question on ascertaining the status of an individual wherein they have given a point where he has stayed in India between 120 and 182 days. So you have to apply the 120-day rule and see whether he is a resident or non-resident. If he is a resident, he automatically becomes a ordinary resident. There is also this point of what is the meaning of total income during the previous year other than income from foreign sources. Because the key point in this particular condition is an income point. Income was never part of the definition of residence before. It was always the number of days of stay in India. Literally taking the meaning of the word resident from the dictionary, it was always about stay in India during the previous year or some years preceding the previous year. Now, income is also one of the conditions, and that income should not. I mean, that income should exceed rupees 15 lakh for this particular rule to be applicable. So, what do you mean by total income other than income from other sources? There is also a very, very small definition given of this other than income from foreign sources. Now, total income is nothing but your total income. But Other than income from foreign sources means every income which accrues or arises outside India, or income which does not accrue or arise in India, is treated as other than income from foreign sources with one exception. I repeat, what do you mean by income from foreign sources? Income which accrues or arises outside India, or income which is not deemed to accrue or arise in India, is income from foreign sources with one exception. If there is an income which accrues or arises outside India, out of a business controlled from India or a profession that is set up in India, then that is not income from foreign sources. I'll repeat this once again and let this be very, very clear, because you have got to be very clear on this particular section, because it does appear to me that there is a likelihood of a question being asked from this particular point. Total income should exceed rupees 15 lakh for this condition to be applicable. What is total income? Total income means income other than income from foreign sources, which means income from foreign sources are excluded in calculating rupees 15 lakh. What is the meaning of income from foreign sources? Income which accrues or arises outside India is income from foreign sources, with one exception. If the income accrues or arises outside India from a business which is controlled from India, or from a profession which is set up in India, then such income is not income from foreign sources. It is considered in calculating the limit of 15 lakh rupees. Once again, so that the concept is crystal clear in your minds, total income exceeds 15 lakh, this particular provision is applicable. Total income does not include income from foreign sources. Income from foreign sources are incomes which accrue or arise outside India, except for an income which accrues or arises outside India from a business which is controlled from India, or a profession which is set up in India, in which case this particular rule is applicable. It's been a very long time since a question on the rule of residence has appeared at the intermediate level, and that perhaps could prompt the examiners to ask questions from section 6, or rather, this is section 6, subsection 1A. Okay. And please note that the rule specifically says that in case these three conditions are satisfied, the individual becomes a not ordinarily resident. The individual becomes a not ordinarily resident. For beginners, understand that the moment you become a resident, you have to further see whether the individual is an ordinarily resident or a not ordinarily resident by further applying two more rules, which will not be discussed here because that would be out of context. The moment an individual is a non-resident, there you are ascertaining his residential status stops. But the moment he is ascertained to be a resident, you have to further see whether he is an ordinarily resident or a not ordinarily resident by applying certain rules. Now, this particular rule of residence not just says that the individual is a resident, but also straight away says that the individual is a not ordinarily resident. What are the consequences of this particular amendment? Be careful. What are the consequences? What happens if this particular amendment is applied in a practical way? The moment now, previously, if you had stayed in India for less than 182 days and your whatever be your income, there were enough chances that you would become a non-resident if you are an Indian citizen who visits India, or an Indian citizen or a person of Indian origin who visits India. The 182 rule had to be satisfied. But now it is the 120-day rule, which means if you stay in India for more than 4 months in a financial year, you straight away become a resident and a not ordinary resident. It means that not just your Indian income is chargeable to tax, even your foreign income out of a business which is controlled from India or a profession which is set up in India is chargeable to tax, is therefore chargeable. That is the very brief consequence of this particular amendment. If you have got any doubts or queries, you can type them in the chat window. But this is all that I wanted to talk about section 6, the amendments that have taken place in section 6 of the Income Tax Act. Let us now move further. Now, yeah, so this is something that I've already explained. So income from foreign sources means income which accrues or arises outside India, except for income from a business controlled from India or a profession which is set up in India. So I've explained this umpteen number of times, and I hope the concept is very, very clear. Now, there is one more point under Section 6 which says that such person will be a not ordinarily resident even if he is not liable to pay tax in any other country or territory by reason of his domicile or residence or any other criteria of similar nature. This is one more such amendment, that one more change that has been introduced under Section 6. But this perhaps is a concept which at the CA final level could be relevant. You at this particular stage need to be aware that now the 182-day rule that is applicable, but also not just 182-day rule, the 60 also the 120-day rule that is applicable. And in case the 120-day rule is satisfied, remember for one last time, the individual becomes a not ordinarily resident, NOR, or not ordinary resident. Let's now move further to certain other things, certain other changes that have taken place. So, if we were to rank the amendments in terms of their importance, the amendment to Section 6 ranks among the top three by Finance Act 2020, especially from a CA intermediate student point of view. Now, let's now move on to certain other amendments. So, the next chapter that we have is computation, or I'm sorry, incomes which do not form part of the total income. There have been no amendments that have happened there. Then we move on to the heads of income. Very, very important heads of income. And please remember, uh, at least 3 to 4 questions will be asked from this particular module. This is a huge module in the context of the CA intermediate taxation paper. 5 heads of income, especially profits and gains from business or profession, capital gains, salary. Almost you can expect 1 question each from these 3 heads of income. So some changes have taken place here. Could be minute, but nonetheless they are very important. So let's now go on to 17.2 of the Income Tax Act. Salaries is the head of income that we are talking about. And under salaries, you have got the definition of salary under 17.1, definition of perquisite under 17.2, and the definition of profits in lieu of salary under 17.3. Perquisite is nothing but salary that is paid to you in terms of benefits extended or reimbursements given. And while valuing perquisite, you take into account the different valuation rules which exist, as well as Section 17.2, which defines perquisite. There is a slight change in the definition of perquisite given under 17.2. Now they are saying that if there is a contribution by the employer to a recognized provident fund, to the national pension scheme under 80CCD1, or to an approved superannuation fund, if it exceeds 7,50,000, the amount over and above 7,50,000 will be treated as perquisite. Most importantly, it will be treated as salary, and it's therefore taxable to tax. Recognized provident fund, we all know before this amendment, contribution by employer to recognized provident fund was taxable if it exceeded 12% of the salary of the employee. Contribution by employee to recognized provident fund was eligible for deduction under Section 80C, subject to the limit mentioned under Section 80CCE. Interest was taxable if it exceeded a prescribed rate. But contribution by employer to a recognized provident fund was taxable only if it exceeded 12% of the employee's salary. Now, there is a monetary limit there mentioned also, which is 7,50,000 rupees, which means even if it has not exceeded 12% of salary, if the total amount of contribution of the employer is more than 7,50,000 in a year, the excess directly becomes salary. Please remember that. For example, suppose the income of a particular employee, say in a given case, is 10 lakh rupees. 10 lakh rupees per month. 10 lakh rupees basic per month, let's presume, as salary. Suppose 12% is the employee's contribution, which comes to 1,20,000 per month is the employee's contribution. Previously, if this was the case, as the contribution does not exceed 12% of the salary, 1,20,000 in this case, the entire 1,20,000 was treated as exempt income in the hands of the employee. Now, 1,20,000 per month, multiply it by 12, you arrive at 1 crore 44, I'm sorry, 14 lakh 40,000. Excess of 7 lakh 50,000, the entire amount becomes chargeable to tax. In this case, 6 lakh 90,000 becomes chargeable to tax. Understand the difference now? 1 lakh 20,000 per month is the contribution to the recognized provident fund by the employer. If 10 lakh was the salary, previously this was fully exempt for being within the threshold limit of 12% of salary. Now that it is 14 lakh 40,000, exceeds 7 lakh 50,000, the difference becomes chargeable to tax. NPS contribution by employer under section 80 CCD 1. 80 CCD, when it was originally introduced, was very liberal, but of late there have been a lot of limits that are prescribed for deductions, for exemptions, and one such cut that has been introduced is through 17(2) amendment, where now they are saying that if there is a contribution to NPS by the employer, if it exceeds 7,50,000 for the entire year, the excess is chargeable to tax. The same applies to contribution to approved superannuation fund. If it exceeds 7,50,000, it is chargeable to tax. You can expect a multiple choice question on this, as simple as the example that I have given. If the salary is so and so per month and so is the employer's contribution, what is chargeable to tax? They will give the percent as within 12%, perhaps 12% itself. But if you calculate the amount of the employer's contribution, it would exceed 7,50,000 per year, in which case the excess needs to be brought to tax. That's the amendment for 17(2). That is the only amendment in the head of income salary. So we move on to income from house property, where there are hardly any amendments that have happened, and we move on to income from business or profession. A very, very important head of income. 2-3 questions will definitely be asked in the subjective part, and in the objective part also you can expect some questions to be asked from profits and gains from business or profession. The third head of income, a very, very important head of income, which runs from section 28 to section 44 BB of the Income Tax Act. Two very simple amendments. Section 35 is actually not an amendment that has taken place. Section 35 talks about deduction available for expenditure on scientific research. Section 35 was very famous for giving something called weighted deductions, where you spend 100 but you get a deduction of 125, 150, and in some of the previous years the deduction even extended to 200, or 200% of the expenditure incurred was available as deduction at one point in time. Now all these weighted deductions have been phased out, absolutely phased out from the law, and for assessment year 2021-22, the deduction available would be for an amount equal to the amount of expenditure incurred. So section 35 talks about revenue expenditure on scientific research, capital expenditure on scientific research, contribution to national laboratory, contribution to approved institutions for scientific research or research in social science or statistical research, and so many other things. All these expenses which were eligible, in fact many of these expenses which were eligible for weighted deductions, everything has been phased out, which means from the present year onwards, if you identify an expenditure on scientific research or a contribution for scientific research, you are supposed to only give 100% deduction for such expenses, because now the deduction is limited to the amount equal to the amount of expenditure incurred. If you are learning the income tax law for the first time, you have come across section 35, which says that the deduction is equal to the amount of expenditure incurred, you may not face any surprise. But if you are writing the CA intermediate exam for the second time, then you would know that it was weighted deductions before, which have been scrapped of late. Eligible modes of payment. This is also not an amendment in the law, but a notification that has been issued by the government of India. So previously section 40A, which limits the cash payments that can be done by a business or a profession to be eligible for deduction under the Income Tax Act. The section 40 is told that in case the expenditure exceeded rupees 10,000, then the payment has to be made through prescribed mode, through account pay check or draft drawn on a bank. And then there were certain exceptions that were mentioned in Rule 6D. Now they have told that even if you make the payment through these prescribed modes, they are considered as eligible for deduction. So cash is ruled out, but these prescribed modes are now allowed as eligible for deduction. What are these prescribed modes? So even if you make the payment by credit card, if an eligible expenditure is paid through debit card, net banking, IMPS, UPI, RTGS, NEFT, or through your Bhim Aadhaar Pay, in that case, they are eligible for deduction. So somewhere in a very large problem, somewhere in some point it will be mentioned that a traveling expenditure is paid through UPI, through a Google Pay, and the amount is 12,000 rupees. You are supposed to ignore this in the sense that not disallow this particular expenditure, because now it is a permitted mode of payment as mentioned under the income tax law. Right. 44AB talks about audit of books of account, and this is an extremely important amendment, especially for the CA final level. I'm not sure whether what kind of question could be asked at the CA intermediate level on this, though section 44AB appears prominently in your study material. There could be an objective question also. Now, section 44AA, maintenance of books of account, and section 44AB, audit of books of account, appear in the PGBP chapter. 44AB specifically lists out 4 cases where audit of books of account is mandatory under the income tax law. I am talking about pre-Finance Act 2020. Audit of books of account is mandatory in the following 4 cases. Number 1, if the SSE is carrying on a business and the turnover exceeds rupees 1 crore. Number 2, if the SSE is carrying on a profession and the turnover exceeds rupees 50 lakh. Number 3, if the SSE is carrying on a business mentioned under section 44AE, 44B and 44BB, and claims an income lower than the income that is presumed under these sections, then he has to get his audit books of accounts audited under the income tax law. And also audit of books of account is mandatory in case section 44AD subsection 4 is applicable. So these were the 4 situations where audit of books of accounts was considered as mandatory or compulsory. Now there is a new introduction to section 44AB. 44AB clause 1 said if the SSE is carrying on a business and the turnover in the business exceeds rupees 1 crore or 100 lakh, then audit of books of account is mandatory. As a proviso to this particular subsection of section 44AB, a new change has been introduced. Now what does this change say? If the total sales, turnover or gross receipts does not exceed rupees 5 crore, understand the words used there, does not exceed rupees 5 crore, and aggregate of the cash receipts in the previous year is less than 5% of the total receipts, and aggregate of the cash payments in the previous year is less than 5% of the total payments. If all these 3 conditions are satisfied, then audit under section 44AB is not applicable. So subsection 1 said if your turnover crossed 1 crore, audit is applicable. This is an exception to this rule, where even if your turnover crosses 1 crore, audit is not mandatory if all these 3 conditions are satisfied. Condition number 1, the turnover does cross 1 crore but it does not exceed 5 crore. Condition number 2, what does this say? Aggregate of cash receipts in the previous year is less than 5% of the total receipts. A little difficult to fathom if you are reading this whole section 44AB at a very theoretical level, because practically you would understand the kind of problems one faces looking at the books of account, trying to identify the total receipt and trying to identify the aggregate cash receipts in the previous year. But maybe at a theoretical level, this is slightly easier to understand. All you have to see is what are the total receipts of the concern, how much of these total receipts have been received by cash, and if this total receipts by cash is less than 5%, then this particular condition is satisfied. Total receipts, obviously, we mean by the total sales of the business, the total credits in the P&L account, your turnover, your gross receipts, total sales in the business. Total payments basically mean all expenses incurred by you. Out of these expenses, how much is paid by cash, and whether this proportion is less than 5%. If that's the case, if other two conditions are also satisfied, then audit of books of accounts under section 44AB is not applicable. Okay. Now, the turnover limit is slightly easy to understand, does not exceed 5 crore. But when it comes to understanding the aggregate cash receipts, the aggregate cash payments, there are a number of problems that are faced practically. Though one must say that at the question paper level of a CA intermediate students, the problem could be as simple as the turnover is 4.5 crore, the total receipts is 4.5 crore, the total receipts in cash is 2 lakh rupees, the total payments done is 4.2 crores, the total payments in cash is say 10 lakh rupees, whether audit of books of accounts is applicable or not. So be mindful of this. The turnover should not exceed 5 crore. If the turnover exceeds 5 crore, then this whole section goes out of the window. Number two, please also remember this is applicable only to an SSE carrying on business. This is not applicable to an SSE carrying on a profession. So this particular proviso is a proviso to the first subsection of section 44AB, which talks about if the turnover of the SSE exceeds 1 crore, then audit is mandatory. The second subsection, which says if the SSE is carrying on a profession and if the gross receipts exceed 50 lakh, then audit is mandatory. This particular condition is only meant for an SSE carrying on business. Number one. Number two, his turnover should not exceed 5 crore. If the turnover exceeds 5 crore, don't look at the total cash receipts or total cash payments or total receipts or total payments. The moment the turnover exceeds 5 crore, it's done. And then if the turnover doesn't exceed 5 crore, you should then calculate the cash receipts by total receipts and see whether it is less than 0.05, the cash payments by total payments, and whether the proportion is less than 0.05. These conditions are satisfied, then no, you don't save taxes. All that happens is that audit of books of account then is not mandatory. I think in Finance Bill 2021, they have raised this percent from they raised the turnover limit from 5 to 10 crore, but that's a different thing. The bill is yet to be passed. So let's focus only on Finance Act 2020. There is a second amendment that has taken place. The due date for filing returns of income for SSE covered by section 44AB would now be 31st October of the assessment year, and the date of filing audit reports under section 44AB would be 1 month prior, which would be 30th September of the assessment year. Please note, previously the due dates used to be the same, which was 30th September of the assessment year, both for filing returns of income as well as filing audit reports under section 44AB. Now they have split it into two different provisions. They are saying the due date for filing returns of income is 31st October, something that we will see under section 139 also. And they have told that the audit report under section 44AB has to be filed 1 month prior to this particular due date, which means it would be 30th September of the assessment year. So that is the amendment that has happened in profits and gains from business or profession, the third head of income, 35 and yes, 35, not an amendment, basically a phasing out of weighted deductions. 40A, once again not an amendment, it's a notification issued prescribing the modes of payment, eligible modes of payment. 44AB, quite an important amendment, but I would think at the CA final stage this could turn out to be quite important, especially in terms of the receipts and payments being mentioned and the student being asked to calculate the total receipts, the cash receipts, and identify the percentage. So let's now move on to the fourth head of income, which is income from capital gains. Income from capital gains is an equally important chapter, and almost on a regular basis you can expect one large question on income from capital gains, asking you to compute capital gains. Slum sale under section 50B has undergone a very slight change. I hope everyone is aware of what is a slum sale. Sale of an undertaking without assigning values to individual assets and liabilities is called slum sale. There is a certain mode of computing capital gains in case of the transfer being slum sale. A small amendment having taken place there. Every SSE in the case of a slum sale shall furnish a report of a chartered accountant certifying the computation of net worth, because net worth is deemed to be the cost of acquisition in a slum sale, in the prescribed form before 30th September of the assessment year. This is a change that has happened under section 50B. May not be important uh, whether the CA intermediate or the CA final. This is an extremely important amendment that has taken place and almost surely will be asked. Those is a very amendment which has got enormous implications, no doubt, but nonetheless a very, very small amendment. Section 50C, a very important section in capital gains. What does section 50C say? Section 50C says when you are transferring an individual, when you are transferring an immobile property, I'm sorry, when you are transferring an immobile property, the consideration for that immobile property is deemed to be the stamp valuation of that immobile property. Now, originally section 50C said that if the valuation for stamp duty purposes is more than the actual consideration for the sale of the immobile property, then such stamp valuation is deemed to be the full value of consideration for calculating capital gains. At a very, very simple level, suppose you are selling a house for 40 lakh rupees, but the stamp duty value of this particular house is 45 lakh rupees. You are selling it for 40 lakh rupees. That's the money that you have received. That's the amount that is mentioned in the agreement. Everything is for 40 lakh rupees. But the stamp valuation of this particular house is 45 lakh rupees. The law through section 50C said that you have to calculate capital gains presuming the consideration not to be 40 lakh rupees but to be 45 lakh rupees. In other words, if the stamp duty value of the immobile property was more than the actual consideration, the stamp duty value was deemed to be the full value of consideration for calculating capital gains. This was section 50C before. Slightly harsh, but whether it is harsh or liberal on the SSE is not the point of discussion here. Now, a couple of years back, the government realized the harshness of this provision and brought in an amendment which said that if the difference between the stamp duty value and the actual consideration is not more than 5%, then is not more than 5%, then forget the stamp duty value. The actual consideration is deemed to be the actual consideration for calculating capital gains. So in my particular example, where a house is sold for 40 lakh rupees, and if the stamp duty value is 41 lakh rupees, if the stamp duty value is 41 lakh rupees, it is higher than the consideration, but it is not more than 5%. Okay, the difference is just 1 lakh, so it is not more than 5%. 5% of 40 lakh is 2 lakh, so it should, if it is more than 42 lakh, it would have been a different case. If it is not more than 5%, then the law now said that 40 lakh is the actual consideration for calculating capital gains purposes. So there was a margin of 5% that was given to the SSE. Some sort of a relief was provided for transfer for computation of capital gains on immobile property. Now, through Finance Act 2020, this margin of 5% has been increased to 10%. Now they are saying if the stamp duty value is not more than 10% of the actual consideration, then the actual consideration is deemed to be the actual consideration. Once again, in my example, therefore, if you are selling a residential house for 40 lakh rupees and the stamp duty value is 43 lakh rupees, you are selling a house for 40 lakh rupees, the stamp duty value of the house is 43 lakh rupees, it is more by 3 lakh, but 3 lakh by 40 lakh is 7.5%, which is less than 10%. So even if in my example the stamp duty value is more than the actual consideration, the actual consideration is deemed to be the consideration for calculating capital gains. Students, please understand the consequence of this particular amendment. Highly likely that one small uh, remark will be given somewhere in the problem that the immobile property is sold for 1 crore and the stamp valuation is 1 crore 9 lakh or 1 crore 11 lakh, 1 crore 6 lakh. Okay, understand that if the stamp duty value does not exceed 110% of the actual consideration, the words used are does not exceed 110% of the actual consideration, then the actual consideration goes into calculating the capital gains and the stamp duty value is to be completely ignored. Once again, remember the words does not exceed. Therefore, if a 40 lakh house is sold for 40 lakh, where the stamp valuation is 44 lakh, exactly 110% of the actual consideration, then also the actual consideration goes into calculation of capital gains and not the stamp duty value. The stamp duty value in this case was 44 lakh 1 rupee, then the whole situation turns upside down and 44 lakh 1 rupee becomes the full value of consideration for calculating capital gains. I'll read out the amendment once again for you. Very, very important, could be asked at the CA intermediate level and also at the CA final level. If the stamp duty value does not exceed 110% of the consideration for the immovable property, then such consideration will be full value of consideration for calculating capital gains. Okay, the stamp duty value therefore comes into the picture only if it exceeds 110% of the actual consideration. Otherwise, you need not consider the stamp duty value at all. Because this 110% has been changed from 105%, it was 105% the year before, now it is 110%. Likelihood that a question will be asked where the stamp duty value is between 105 and 110%, and you should not be confused. Very clear in the mind, if it doesn't exceed 110%, the actual consideration becomes the consideration for calculating capital gains. Section 55 defines cost of acquisition while calculating capital gains. There is a rule which says, now I mean all the students watching this telecast live or deferred should be knowing that while you calculate capital gains, the formula is as simple as this: full value consideration less cost of acquisition less cost of improvement less transfer expenses gives you capital gains. Full value of consideration, nothing but the sale price, less cost of acquisition, nothing but the purchase price, less cost of improvement, capital expenditure on the capital asset that you have done after its acquisition, less transfer expense, there is a definition of transfer expense, gives you capital gains, long term or short term. What is cost of acquisition? It is the purchase price. Usually it is the purchase price. There is a definition of cost of acquisition that follows under section 49, which says that cost of acquisition is actual cost of acquisition in the hands of the SSE, except where the asset was acquired before 1/4/2001. The law says cost of acquisition is actual cost of acquisition in the hands of the SSE, except where the capital asset was acquired before 1/4/2001. So what happens if the capital asset was acquired before 1/4/2001? The SSE is given an option. If the capital asset is acquired before 1/4/2001, the SSE has the option to either choose the actual cost of acquisition whenever the asset was acquired before 1/4/2001, or the fair market value of the capital asset as on 1/4/2001 at his option. If the capital asset is acquired before 1/4/2001, the cost of acquisition will be the actual cost of acquisition or fair market value of the capital asset as on 1/4/2001 at the option of the SSE. The SSE will obviously choose a figure whichever is higher, either the actual cost of acquisition then or the fair market value as on 1/4/2001. Whichever is higher is usually chosen because that gives you a higher deduction. Section 55 has made a small amendment to this particular rule. Rather not an amendment but an addition. Now they are saying if a capital asset is acquired before 1/4/2001, this is what we are now targeting at. If a capital asset is acquired before 1/4/2001, now they are saying if that capital asset is an immovable property, if that capital asset is an immovable property acquired before 1/4/2001, for the purpose of fair market value as on 1/4/2001, you have to take the stamp duty value of that immovable property as on 1/4/2001. Okay, Fair market value is what? The definition was slightly vague before. Do you go back to 1/4/2001 and look at the stamp duty value? Do you value it with a valuer now? But the valuation being as on 1/4/2001 was slightly difficult in practical terms. So now the law has provided some clarity where they have said that if it is an immovable property, being land or building or both, and it is acquired before 1/4/2001, where the SSE is given an option to choose a cost of acquisition, the fair market value option available to the SSE would be the stamp duty value of the immovable property as on 1/4/2001. As on 1/4/2001. Where capital asset, being land or building or both, became property of the SSE before 1/4/2001, the FMV of the asset shall be the stamp duty value. Shall be, which means it will be stamp duty value wherever available as on 1/4/2001. Okay, so there is some clarity that the law provides. Now you need not go to a random valuer, a chartered engineer or an approved valuer to value the property as on 1/4/2001, because the law now says very clearly, go to the sub registrar's office, find out the stamp valuation of this property as on. He will have a table of giving the stamp valuations of the property at different times. Find out the stamp valuation of this particular property as on 1/4/2001. This is a change that has taken place. Once again, could very much be applicable at the CA intermediate level. Let's now go on to the last head of income, income from other sources. Slightly ignored by the CA students, whether at the intermediate or at the CA final level. Income from other sources, incomes which are not to be excluded from the total income, but are not to be included in any of the four previous heads, are to be included in income from other sources. This is a residuary income, a residuary head of income, where incomes which do not belong to the first four heads of income but are not exempt from tax are included under this particular head, which is income from other sources. One of the most important incomes under income from other sources used to be dividends, but then dividends were exempt from tax before. Hence, there was not much importance that was attached to dividend income. If the problem mentioned dividends, automatically the student would exempt dividends from tax. The only other possibility would have been dividends declared by a foreign company or dividend declared by societies other than domestic companies, in which case they were chargeable to tax. The law was very simple. Dividends declared by domestic companies or mutual funds exempt from tax at a very simple level at the CA intermediate. Now this has changed. Dividends now are chargeable to tax. Dividend is fully taxable. Okay, and therefore you need to be aware that in case there are dividends, whether declared by a domestic company or not a domestic company or a foreign company, no matter what it is fully chargeable to tax under section 56 of the Income Tax Act. Very, very important amendment this at a practical level for the CA final students as well as of course for the CA intermediate students. Though at the intermediate level you can only expect in a computation of total income problem somewhere dividend being mentioned. Now you have to be aware, mindful of the fact that it is not exempt from tax. But at the CA final level a lot of other possibilities also exist. So dividends therefore are chargeable to tax. Two or three things about the taxability of dividends. The first point being, please note this particular change and be very clear. Dividends distributed by a domestic company before 1/4/2020 but received by the shareholder in 2020-21, on which tax under section 115O has been paid, will still be exempt. This particular provision is applicable only for the previous year 2021 or assessment year 21-22. Understand this point, and there could be an examiner, especially at the CA final stage, who could play some mischief here. The dividend is distributed before 1/4/2020 or before 2021 financial year, but the shareholder receives the dividend in 2021 financial year on or after 1/4/2020. In this case, the dividend is exempt from tax. Okay, in this case, the dividend is exempt from tax. Why? Because the dividend was distributed before 1/4/2020, 115O was applicable in 1920, DDT was paid, and it was exempt in the hands of shareholders. If it was received in 2021, the shareholder maintains books on cash basis. He has received dividend in 2021. It is fully exempt from tax. This particular possibility exists only for the 2021 financial year. One more point I wanted to make about dividend. The point of deductions being available under section 57 of the Income Tax Act. 57 talks about deductions available from in computing income from other sources, and the first point there that is made is what are the deductions that you are going to get against the dividend income. Now remember, usually the thumb rule in income from other sources is that whatever expenses you incur in earning the income is eligible as deduction. Just like income from business or profession, even in income from other sources, the general rule is that expenditure incurred in earning the income is eligible as deduction from the income. However, for dividends, they almost say the same thing but then cut it off. No deduction shall be allowed against dividend income other than deduction on account of interest expense incurred to earn the income. Therefore, if you have got dividend income in the problem, the only deduction that you can give for is interest expenditure that you have incurred to earn this particular dividend income. Now, once again, remember what is the interest expense that is talked about here? I take a loan from someone or a financial institution. This amount is invested in shares of companies, which later declare a dividend. So I get dividend income from these companies. I have paid interest on this loan taken from someone or a financial institution. This interest expenditure is available as deduction against this particular income. And this is the only deduction that is available against this particular dividend income and no other. So you have to pro rata calculate the interest which relates to this company's dividend and give it as a deduction. What's more, there is one more limit that is mentioned there. The deduction for such interest expenditure is restricted to 20% of the income, which means invariably at least 80% of the dividend is fully subject to tax. This is an important amendment, and whenever they give these percentages 20%, 10%, one always fears that an objective question is on the cards. An objective question is likely to be asked. Okay, so number one, dividends are now chargeable to tax, whether it is domestic company or non-domestic company, foreign company, or whatever it is, dividends are chargeable to tax. Number two, only interest expenditure is available as deduction against such dividend income. Number three, even if the interest expenditure is eligible as deduction against the dividend income, the deduction is restricted to 20% of such income. So in a given case, the total dividends that the individual has earned is 50,000 rupees. The interest expenditure in earning the dividend is say 12,000 rupees. 50,000 into 20% is 10,000. And even if the expenditure is 12,000, the deduction is limited to 10,000. What is chargeable to tax therefore is 50,000 minus 10,000, 40,000 rupees. Okay. This is a straightforward rule, and therefore the fear that objective questions would be asked from this particular. Therefore, please remember as we exit the heads of income, please remember dividends are now chargeable to tax, especially if you are writing the exams for the second time. Please remember dividends are now chargeable to tax. The deduction is available only for interest income, and the interest income is also deductible to the extent of 20% of the dividend income. Once again, this ranks as one of the top three amendments that have been introduced by Finance Act 2020. This amendment seems very, very simple when you look at section 115 EEC later. This amendment seems very, very simple. I request everyone who is watching this telecast live or deferred to be very, very mindful of section 56 and section 57 of dividends, of deductions that are available. Very easy to remember also. Let's now move on to, we have now moved beyond the heads of income. We have now gone on to clubbing of income, on which no amendments have taken place. Set off and carry forward of losses, on which also hardly any amendments have taken place. So let's move on to chapter 6A deductions. Chapter 6A deductions, which run from section 80C to section 80U of the Income Tax Act. Only those deductions which are applicable to individuals and NGFs are mentioned at the CA intermediate level. There are certain other amendments that have also taken place at the CA final level, which could be important there, but at the intermediate level, we are only talking about taxation or assessment of individuals. Two amendments I want to highlight. Very, very simple amendment. The first one is section 80EEA, interest on housing loan. Very, very simple amendment this is. 80EEA talks about deduction for interest on housing loan. A little bit of background on this particular section. Interest on housing loan is also eligible for deduction somewhere else. Interest on housing loan is eligible for deduction when you calculate income from house property. When you calculate income from house property under section 22, interest on housing loan is deductible under section 24 of the Income Tax Act. There is a limit. If it is a let out property, if it is a self-occupied property, there is a limit. If it is a let out property, there is no limit. 80EEA was brought into the law to give some extra relief to the SSCs in addition to the deduction that you get under section 24 of the income tax law. Because the value of houses were rising and people were also taking large housing loans, there was this tendency that you incur interest payments in lakhs of rupees, but section 24 gave you a deduction of only 2 lakh for a self-occupied property. There was no limit on the let out property, but on the self-occupied property, the deduction was limited to 2 lakh. And what if your interest expenditure in the initial years, especially, turns out to be 2 lakh 50, 3 lakh, 3 lakh 50, and if there is a pre-construction period also, you tended to lose a lot of deductions there. 80EEA was introduced to tell that you will get an extra deduction under 80EEA for the interest on housing loan over and above whatever you have got there. You cannot take deductions under both sections. You can take deduction only under 80EEA as well. You can take deduction only under section 24 while calculating income from house property. But if the interest amount is more than the limit that is mentioned there, 80EEA is waiting for you under chapter 6A. Now, there were a lot of conditions that are mentioned under section 80EEA. There is a restriction on the value of the house. There is a restriction on the deduction that is available. But most importantly, there was a restriction that the loan should be taken from 1st April 2019 to 31st March 2020. Only then 80EEA is applicable. The loan should be taken from 1st April 2019 to 31st March 2020. Only then the loan is eligible under 80EEA. Now they have extended the term available for taking of the loan from 1/4/2019 to 31st March 2021. That's all. That's a limited amendment that has taken place, and hence I explained 80EA in greater detail so that you understand. So loan should be sanctioned by the financial institution between 1/4/19 and 31/3/20. Now they have said between 1/4/19 and 31/3/21, which means even in previous year 2021, the loan is taken. Interest on this loan is eligible for deduction in section 80EEA. Of course, once again remember, there is no question of a double deduction for interest on housing loan. In fact, not just for interest on housing loan, for anything under the income tax law. Another very small amendment that has taken place under chapter 6A is 80GGA. 80GGA is deduction for scientific research and rural development. Cash donations were eligible for deduction up to rupees 10,000. I'm sorry, there is a slight mistake here that is made. There is a slight mistake there in the slide. Cash donations up to 10,000 were eligible for deduction before. Now, deduction is limited to 2,000 rupees. I mean, in case there are cash donations made exceeding 2,000 rupees, they are disallowed under 80GGE. There is a slight mistake in the way it is written. Previously, it was up to 10,000 cash donations were eligible for deduction. Now it is up to 2,000. Up to 2,000 cash donations are eligible for deduction. So any cash donation made over and above 2,000 is not eligible under 80GGA. There is a mistake there on the PPT. Let's now move on to the big one, the biggest amendment by Finance Act 2020 causing ripples across the country was section 115 BAC. In terms of your chapters, we have now moved on to module 3, the last of the modules. I'm sorry, I think we are still in module 2, which is talking about computation of total income. So in computation of total income, they ask you to calculate total income and they ask you to calculate tax on total income. Usually a 16 mark question awaits the student as question number 1, mandatory question when you attempt a CA intermediate paper. If you look at any of the previous question papers, question number 1 is always mandatory and usually it is on computation of total income. They will focus on one of the heads of income, could be salary, could be income from business or profession, but more or less at the end of it, they will ask you to calculate total income and tax on total income. And when you see the marks bifurcation for this 16 mark question, usually it is about 13, 14 on the computation of total income part and 1 or 2 marks, 2 or 3 marks for the computation of tax part. Because computation of tax part was only supposed to be a formality. You are all presumed to know by heart the income tax slab rates that are applicable for an individual. Now the tables have turned. 115 BAC has made computation of tax a very, very curious case. Because 115 BAC gives you something called option. So, for the first time in a zillion years, the Indian income tax assessee has options before him on the table to choose one of them, calculate his tax, and pay taxes to the government. So, have this very, very clear thing in mind that whenever you have options before you, if it's for payment of tax, you're always supposed to take that option which is on the lesser side. And when it comes to deduction, exemption, you're always supposed to take an option which is on the higher side, because you're always supposed to think and write an exam from the SSC's point of view. 115 BAC gives an option. There's a long history behind 115 BAC. For lack of time, let me restrict it to the finance minister's speech, who, while proposing 115 BAC during the budget 2020, went on a rant about how exemptions and deductions have piled up in the income tax law. Her main grouse was there was no limit on the number of sections which were focusing on exemptions and deductions, and that has made this whole income tax act very, very bulky, not at all simple, and very difficult for the common layman to understand. And what does she do? She introduces one more section which runs into pages called section 115 BAC. But jokes apart, let us now start focusing on what 115 BAC and look at it like a mathematical equation. Whether at the CA intermediate or at the CA final stage, you have to look at this particular section like a mathematical equation and tick individual boxes. Let's straight away start 115 BAC by understanding to whom it is applicable. It is applicable only to an individual and HUF. Hardly matters at the intermediate stage because you are in any case focusing on individuals and HUF. The CA final stage, remember, not applicable to a company or an association, only to an individual and an HUF. Number one. Number two, it is not applicable to those incomes where special rates are involved. Such incomes where the rate of tax is special will have to be taken out and 115 BAC will have to be looked at. What are these incomes which are taxed at special rates? It could be short-term capital gains under 111A. It could be long-term capital gains under 112A. Even long-term capital gains not where 112A is not applicable. It could be winnings from lotteries, crossword puzzles, etc. It could be several other incomes which are charged to tax at special rates as well. So in that large problem, if there are incomes on which special rates are applicable, they have to be excluded. Only the incomes which join your regular slab rates, 115 BAC is applicable. So understand these two things very clearly in mind. Individuals and HUF, only to individuals and HUF, 115 BAC is applicable. And number two, 115 BAC is applicable, is rather not applicable to incomes which are chargeable at special rates. Once we have opened the door of 115 BAC, the next thing is, what has the finance minister done here? She has prescribed a fresh set of slabs. A fresh set of slabs. What is the existing slab rates? Now, I am presuming that everyone who is watching this is already very conversant with the existing slab rates. What are the existing slab rates? you are an individual who is a very senior citizen, 80 years or above, then up to 5 lakh there is no tax, 5 lakh to 10 lakh the rate of tax is 20%, above 10 lakh the rate of tax is 30%. If you are an individual who has attained the age of 60 years or more, but not 80 years in the previous year, that makes you a senior citizen, the rate of taxes are 3 lakh to 5 lakh 5%, 5 lakh to 10 lakh 20%, over and above 10 lakh the rate of tax is 30%. In the case of every other individual, up to 2 lakh 50,000 there is no tax, 2 lakh 50 to 5 lakh the rate of tax is 5%, 5 lakh to 10 lakh the rate of tax is 20%, over and above 10 lakh the rate of tax is 30%. These are the normal slab rates. What makes things murkier is the special slab rates which is prescribed by section 115 BAC, which is right there in front of you. Up to 2 lakh 50,000 rate of tax is nil. 2 lakh 50,000 1 to 5 lakh the rate of tax is 5%. 5 lakh 1 to 7 lakh 50 the rate of tax is 10%. 7 lakh 50 to 10 lakh the rate of tax on is 15%. 10 lakh to 12 lakh 50 the rate of tax is 20%. 12 lakh 50,000 1 to 15 lakh the rate of tax is 25%. And above 15 lakh the rate of tax is 30%. Now look at the beauty behind these slabs. The differential is always 2.5 lakh. The differential remains 2.5 lakh throughout till you reach 15 lakh. Once you cross 15 lakh, the income tax rate is 30%. If as the differential remains uniform 2 lakh 50,000 throughout, you can multiply 2 lakh 50,000 by the cumulative rate. So if the income is 2 lakh 60,000, then you come under the second slab, 10,000 into 5%. If your income is say 5 lakh, say 6 lakh, if your income is 6 lakh, then 2 lakh 50 to 5 lakh 5%, or 2 lakh 50,000 into 5%, and then 1 lakh in the third slab, 1 lakh into 10%. I hope students are able to identify and calculate the rates of taxes here. Basically, it is 2 lakh 50,000 into accumulated amount. So what is the tax? What is the tax that you have to pay at 10 lakh? The tax that you have to pay at 10 lakh is 2 lakh 50,000 into cumulative 5 plus 10 plus 15% or 30%. So 10 lakh into 2 lakh 50,000 into 30% is what you have to pay. What's the rate of tax that you have to pay at 12 lakh 50,000? Once again, 2 lakh 50,000 into the cumulative rate there, 5 plus 10 plus 15 plus 20, 50%, 2 lakh into 50%. Now, what is the tax that you have to pay at 16 lakh? What is the tax that you have to pay at 16 lakh? Up to 15 lakh, you have got 2 lakh 50,000, but 5 plus 10 plus 15 plus 20 plus 25, these will have to be accumulated. So 5 plus 10, 15 plus 15 is 30 plus 20 is 50 plus 25 is 75. 2 lakh 50 into 75 up to 15 lakh, and then over and above 15 lakh, 1 lakh. I've told 16 lakh is the income, 1 lakh at 30%. This is how I have simplified it mathematically, but you can have your own ways. But understand, in case you are forgetting, that on the left hand side, where you see the total income, the differential is always 2.5 lakh. Up to 2.5 lakh, 2.5 lakh to 5 lakh, 5 lakh to 7 lakh 50, 7 lakh 50 to 10 lakh, 10 lakh to 12.5 lakh, 1.5 lakh. The differential is always 2.5 lakh until you reach 15 lakh. On the right hand side, the rates of taxes, an easier way to remember is it's always in multiples of 5. You start with 5, 10, 15, 20, 25, and finally 30% if it crosses 15 lakh. So this is the new slab rate. In fact, this is not the new slab rate. This is what we call as an alternate slab rate that is applicable to the individual. And this is the beauty of the whole thing. This is not the new slab rate. Okay, it was a slip, but this is not a new slab rate. This is an alternate slab rate that is given as an option to the SSE. What is an alternate slab rate? You have the existing slab rate, you have the new slab rate, calculate tax and identify wherever benefit lies and opt for that particular point. So this is how mathematically 115 BAC is. Now let's move on to the most important point, the conditions associated with 115 BAC. So students should not just remember the slab rates, but the conditions associated with 115 BAC. Right there. First point, certain deductions and exemptions are not available. certain deductions and exemptions are not available. Not as easy as it sounds, not as easy as it sounds at all. There are a long list of deductions and exemptions that have been mentioned here. And in the next slide, we will look at what are these certain deductions or exemptions that are not available. Right, Tom? Just understand certain deductions or exemptions are not available. Number two, set off of loss or depreciation carried forward from an earlier year attributable to any of these deductions are not allowed. Very important. Understand this very clearly. Set off and carry forward in between heads of income is not allowed. Whether it's the present year's loss or the last year's, previous year's loss that has been brought forward. Set off of losses between heads of income is not allowed. Set off of loss from income from house property against any other head of income is also not allowed. Okay, understand this point. Loss or depreciation carried forward from a previous year, they cannot be set off against any other head of income. But when it comes to income from house property or loss from house property, it cannot be set off against any other head of income at all. That is the second point. The first point is certain deductions or exemptions are not available. The jury is out. We will discuss this once again in the next slide. Second point is set off of loss or depreciation. If it is carried forward, cannot be set off against any other head of income. If it is the present year's loss, income from house property cannot be set off against any other head of income. There is a time limit to exercise the option. I have told this repeatedly again and again. This is an option. This is an alternate slab rate, an option that is available to the SSE. How do you exercise this option? If you are an individual or HF who doesn't have income under the head profits and gains from business or profession, then you can exercise the option every year. Every year you can calculate taxes, see which one is beneficial and opt for the option where the tax payable is less. Every year you can weigh both the options at the time of filing your return of income and then exercise one of these options. But if you are an individual or HUF who has income from business or profession, then you can exercise the option once at the time of filing return of income and change it once more. You can exercise it in this year. The new slabs under 115 BAC are beneficial to me. I opt for this slab. Okay. And once you have opted for this slab, in the next year or in the coming years, just once you can overturn the option and choose the other option. But only once. Which means 2 times you can exercise the option if you have got income from business or profession. Once you have changed your option, you can't come back to your previous option ever for the rest of your life. That's what 115 BAC says. For the rest of your life, you cannot change it. You can change it once, but after that you cannot change it at all. But if you don't have income from business or profession, you can keep changing it as many number of times. Every year, you can look at both the options and choose one of them. But if you are having income from business, choose one of them. One more time you can change in any of the future years, but after the second change, after the first change rather, you cannot change it for the second time. Now what if you cease to carry on business or profession? If after a certain while you don't have income from business or profession, you go back to the first point. Wherein you don't have business income, you can keep changing your options. So slightly confusing to understand, even slightly confusing for a practicing professional, also all these options and the new slab rates and all. So we are in for a really dramatic 2021-22 where almost every SSE who comes to a chartered accountant's office will have a lot to talk about 115 BAC, weigh these options and see which one is beneficial, which one is not. This will be the talking point, no doubt, when the return filing season comes for a practicing professional this May, June, July 2021. Right. So I told you certain deductions or exemptions are not applicable. Let's now move on to these deductions or exemptions. This is the crux of 115 BAC. This is what the finance minister had in mind when she introduced 115 BAC. When she told that the reason I'm introducing 115 BAC is because I want to phase out the exemptions and deductions that are there under the income tax law. However, the point is she has cherry-picked certain exemptions and deductions and denied the benefit. This is not everything that is denied. So LTC, leave travel concession and section 10(5) goes out of the window. No exemption is available if you are opting for 115 BAC. Exemption for HRA under section 1013A is not available. All those allowances for which you get exemption in section 10 subsection 14, that exemption goes out. For example, under section 10 subsection 14, if the employee is given an official allowance, the section says if there is an expenditure incurred on the allowance, that is eligible for deduction against this allowance. So that exemption is gone under 1014. Daily allowances, even constituency allowances given to MPs and MLAs under section 10 subsection 17, that exemption is gone. The exemption, a very rich exemption in section 10 subsection 2,500 rupees per minor child, that exemption that you used to get if the minor child's income is clubbed into the hands of the parent SSE or the guardian SSE, that is also gone. Tax holidays that were available for units in special economic zones in section 10AA, that is gone. All deductions that were available in section 16 is gone. Very, very important is all deductions that were available in section 16 are gone. What are the deductions that were available in section 16? 16(1)A gave you a flat deduction of 50,000 from your gross salary. 16(2) gave a deduction for entertainment allowance for government employees from gross salary. 16(3) gave a deduction for profession tax from the gross salary. All these three deductions are not available if you are opting for 115 BPC. Deduction for interest on housing loan for a self-occupied property is gone under section 24. The deduction limit here was 2 lakh rupees. Additional depreciation under section 32 that was available subject to certain conditions is gone. Contribution for scientific research under section 35, the deduction is not available. Deduction section 35 AD, 35 CCC are not available. Fixed deduction that was available for family pension section 57. Section 57, that's a deduction that is available if you have got a family pension. Deduction is limited to 1/3 of the pension amount or 15,000, whichever is less. That deduction goes away. And what's more, the entire chapter 6A is not available. 80C to 80U is not available with two exceptions. Deduction under section 80CCD subsection 2 is still available. 80CCD subsection 2 is still available. What is 80CCD subsection 2? Contribution by employer to the national pension scheme. That is still eligible as deduction. Deduction in section 80JJAA is still available. What is that? Additional employees that are employed, there is a certain deduction that is available as a percentage of their salary for a certain number of years under 80JJA. That is eligible for deduction, or that is available for deduction. So the entire chapter 6A is not applicable with two exceptions. 80CCD2, contribution to NPS of the employee by the employer, and 80JJAA. These two are available. Now this is the challenge as far as 115 BAC goes. The challenge is not just remembering this slab. The challenge is not just remembering this slab. The challenge is also to remember the whole exemptions or deductions that are not eligible under 115 BAC. This is the challenge for the CA student to remember 115 BAC. Take it from me, 115 BAC ranks as the number one amendment that is amended by Finance Act 2020, only from a CA student's point of view. By CA students, and not just me, the CA intermediate students, but also the CA final students. You should be clear about what exemptions are not available while calculating taxes under 115 BAC. That should be 100% clear. In addition to, of course, the slab rates, this list that appears on your screen, you should be 100% sure as to what is available and what is not available. Okay, whether you buy hard, whether you memorize, or whether you solve enough number of problems is left to you, but you should be very clearly knowing that, say, 16 deductions for salary, section 16 deductions for salary, additional depreciation section, set off and carry forward of process not available. These should be very clear. And most importantly, chapter 6A deduction, where certain deductions are available, NPS contribution and 80JJAA. This has to be clearly kept in mind as far as 150 BAC. I would humbly request request and suggest every CA intermediate student who is watching this podcast to read, reread, and reread section 115 BAC. If possible, solve as many problems as you can, because a likely question at the CA intermediate level as well at the CA final level is a situation where you are asked to opt for 115 BAC or not opt for 115 BAC. You are given the case of an SSC, these incomes, these exemptions, and very simply asked you calculate tax. These incomes and these exemptions. Calculate tax, as simple as that. If they just give calculate tax, it doesn't mean you go to the traditional method and calculate tax. It doesn't mean you go to 115 BAC and calculate tax. It means you do both. You have both the options which are spelled out clearly in your answer sheet. Make a comparison and choose whichever is less. Wherever the tax liability is less, choose that option and finalize your answer. Very, very important. Understand this very clearly. Switch on your exemptions and deductions and calculate neatly applying the traditional slabs, the income and the tax applicable. Switch off the exemptions and deductions and calculate neatly the income once again. Remember, the income calculation also changes. And then tax applying 115 BAC, arrive at the total amount, compare the two, and finally arrive at the tax liability of the SSC, suggesting him either to opt for 115 BAC or not opt for 115 BAC, rather go for the traditional method. Remember, the rates of surcharge and the rate of health and education cess remain the same. There is no change whether you have opted for 115 BAC or not opted for 115 BAC. The surcharge and the cess remain the same. Okay. One more time, one last time, let me just recapitulate 115 BAC, because this I think is very, very important, and I would be failing in my duties if at the end of this whole podcast you don't know what is 115 BAC. So let me just recapitulate once again, giving you a nutshell, explaining you a nutshell what is 115 BAC. An extra option given to an individual and an HUF SSC, an extra option that is given to you. One can completely ignore 115 BAC and calculate tax as per the traditional method, calculate income as per the traditional method, or you can take 115 BAC and recalculate your income, recalculate your tax. Number one, applicable only to individuals and HUFs. Number two, it is not applicable to those incomes which are chargeable to tax at special rates. This is the slab rate that is mentioned. Remember this very simply. Do remember that the gap is 2.5 lakh in every slab. Starting with the first 2.5 lakh where the whole entire income is exempt, up to 15 lakh. As far as the rates of tax go, the rates of tax are always in multiples of 5. Starting with 0 and then 5, 10, 15, 20, 25, and finally resting at 30% of the income crosses 15 lakh rupees. Conditions. Certain deductions or exemptions are not enough. Number 2, set off of loss or depreciation. If it is carried forward, it cannot be used for set off at all. Present year's loss from house property cannot be set off against any other heads of income. What is the time limit? If you are an individual or HUF not having business income, at the time of filing return of income, every year you can opt for either. But if you are an individual or HUF having income from business or profession, you can choose an option at the time of filing return of income, change it once in the future, but once you have changed it, you cannot go back to the previous option. What are the deductions or exemptions not available? List is that right here. Absolutely not. To just confuse a bit, for example, interest on loan for a self-occupied home is eligible. However, let out property, then deduction is available. Understand that? When let out property, the interest on housing loan is eligible for deduction. Additional depreciation is ineligible under section 32. Normal depreciation is eligible under section 32. Okay. So let's move on to the next section. I hope I have thrown enough light on 115 BAC so that students understand this very, very clearly. Very, very important amendment. Let's now move on to the chapter intermediate level is advanced tax, TDS, and TCS. A chapter which usually students ignore, but as I've told this already on many occasions, that because there are now multiple choice questions worth 18 marks at the in the income tax paper, you can look forward to a lot of questions from this chapter. Also, these multiple choice questions could be 1 mark, could be 2 marks, but once again, there are 18 different possibilities. Could be. So let's start with TDS. No changes in advanced tax. Let's start with TDS and then move on to TCS. TDS on salaries. Hardly any questions being asked, but let me just very quickly throw some light. As far as TDS on salary goes, two changes have taken place. The employer has to give an option to the employee while deducting tax at source as to either opt for the old scheme of taxes or the new scheme of taxes under 115 BAC. Practically, they are very popular as the old scheme. The 115 BAC thing is called the new scheme of taxes, and the traditional one is usually called the old scheme of taxes. So, every employer under Section 192 now is required to ask the employee while deducting tax at source whether he is opting for old scheme or new scheme. Number one. Number two, another very small change that has been introduced, may not be important at the intermediate level. If you are an eligible startup and if you have given ESOPs or sweat equity shares to your employees, then TDS can be done. TDS need to be done only within 14 days of the earliest of the following: expiry of 4 years, uh, within the expiry of 4 years, or within the date of sale of shares by the employee, or the date of the SSE ceasing to be the employee of the employer. Okay, may not be relevant. Let's move on. 192. Now, amendments to other TDS sections. So there are several other TDS sections applicable here. Now, please remember there are two changes rather which are of great importance here. Number one, the rate of TDS. This is something that you have to be very clear in your mind. The rate of TDS for 2020-21 is 75% of the rate of TDS which is applicable in general in the respective sections. The screen mentions 7.5%. I'm sorry for that error. It should be 75%. Whatever is the rate applicable under a particular section, because of the whole pandemic situation and to improve the cash flow that is applicable to the business, the government of India has notified that the rates of TDS applicable with effect from 14th May 2020 to 31st March 2021 would be 75% of the actual rate mentioned in the section. This is important. This is very important, likely to skip a student's mind when he is answering the question. So if 194J has mentioned the rate of TDS as 10%, the rate of TDS applicable under 194J for 2021 would be 75% of 10% or 7.5%. Understand this. Not true for 2021. It's only for deductions from 14th May 2020 to 31st March 2021. If the rate of TDS under 194C is 2%, the rate of TDS applicable under 194C from 14th May 20 to 31st March 21 is going to be 75% of 2% or 1.5%. Understand this clearly in mind, that whatever is the rate of TDS mentioned in any of the sections under the income tax law is reduced by 25% if the deduction is happening between 14th May 2020 and 31st March 2021. That's the fun part of it, which means the deduction is happening before 14th May 2020, then the original rate is applicable. If it's on or after 14th May 2020 in 2021, then 75% of the applicable rate will be the rate of TDS. Understand this very clearly in mind, because forget students, even practicing professionals had problems in remembering that it is a 75% rate that is applicable. This is very important, and I'm pretty sure there will be one multiple choice question which will ask you to calculate the rate of TDS. They would give you 10% as well as 7.5%. By default, you would tick 10%. Remember, if the deduction is to take place between 14th May 20 and 31st March 2021, it's going to be 75% of 10% or 7.5%. One more change that has taken place: a number of these TDS sections were made applicable to individuals and HUFs only if section 44AB subsection 1 was applicable to them. the limits mentioned in section 44AB subsection 1 was applicable to them. There was some confusion in this regard, which may not be relevant for our present discussion. Now, many of these sections could be 194C, could be 194J, could be 194I. Now, many of these sections now they have changed for them to be made applicable to individuals and HUFs only if in the preceding year, in the year before, the turnover in their business crossed 1 crore or the turnover in their profession crossed 50 lakh rupees. So many of these sections, 194C, 194J, 194I, 194A even, will be applicable to individuals and HUFs only if they were carrying on business in the preceding year and the turnover crossed 1 crore, or if they were carrying on a profession in the preceding year and the gross receipts crossed 50 lakh rupees. So these are the two carte blanche changes that have taken place in the TDS sections. Let's move on to certain other minor changes that have happened. Section 194 is TDS on dividends. The limit is 5,000. Dividends were till now, majority of the dividends were exempt from tax. We have discussed on this already. The limit is 5,000 rupees. The rate of TDS, it was mentioned under 194 that the rates of TDS are the TDS as applicable in force. It would be now 10%. So the rate of TDS on dividends is 10% and the limit is 5,000. Of course, if the dividends are distributed between 14th May 20 and 31st March 21, the rate of TDS would be not 10% but 7.5%. 194C, a very small amendment has taken place. That TDS on cash withdrawal was applicable. Now they have made some more additions to 194. And they have basically scrapped 194 and then introduced a new 194 in its place. The change that has happened is that the income tax return is not furnished. Now, 194N was TDS applicable for cash withdrawals. If you withdraw cash, after a certain limit, the bank, while paying you cash, is supposed to deduct tax at source. Now they have made an addition to this particular point. If ITR is not furnished for 3 immediately preceding assessment years, the rate of TDS would be 2% for cash withdrawals between 20 lakh and 1 crore. And once the cash withdrawals cross 1 crore, the rate of TDS would be 5%. So if your cash withdrawal is limited to 20 lakh and 1 crore, the rate of TDS would be 2%. If the cash withdrawal is more than 1 crore, the rate of TDS is 5%. Of course, remember, if the total cash withdrawals are less than 20 lakh, no TDS is applicable on 194N. This whole set of provision is applicable to a person who has not filed his income tax return for the past 3 years. 194O is once again new section that is applicable. Once again, may not be important at the immediate level. It is applicable to an e-commerce operator who is selling goods or services of an e-commerce participant while paying to the e-commerce participant is supposed to deduct tax at source at 1%, provided the sale of goods or services at cost 5 lakh. Very simply, a very simple model. Suppose I'm Amazon. I am facilitating the sale of goods of Mr. A to the general public. Okay, Mr. A's goods are put up on my website and are sold to the general public. I'm facilitating the same. I'm collecting the consideration and paying it to Mr. A. The law now says if the total payments that I make to Mr. A are more than rupees 5 lakh, at the time of making the payment, I'm supposed to do a TDS of 1%. That's TDS. At least in TDS, remember the threshold limits and the rates of TDS. At least do remember that. So for 194A, for example, it is going to be 5 lakh the threshold limit and 1% the rate of TDS. Once again, 75% of the rate divided between 14th May 20 and 21st March 20. TCS is the last part of this penultimate chapter. TCS is the last part. Once again, the same change as was applicable to TDS would be applicable. 75% of the rates that are mentioned in the section are applicable. Just like TDS, even in TCS, it would be 75% of the rate that is applicable. Two new things that have been introduced in 2021 on which multiple choice questions are likely, or even short questions for 2 or 4 months also. TCS is made applicable to overseas remittance or an overseas tour package. Okay, the word in the screen should read as or and not of. Overseas remittance or an overseas tour package. Overseas remittance or an overseas tour package. The TCS applicable is 5% in case the overseas remittance is more than rupees 7 lakh, and it would be 0.5% if the overseas remittance is out of an educational loan from a financial institution. So the TCS is applicable only if the overseas remittance is more than rupees 7 lakh. The normal rate is 5%. But if it is out of an educational loan from a financial institution, someone is very or a son is studying and the parent has taken an education loan and amounts are repatriated to meet the cost of education or the cost of stay of the son or daughter. If that remittance crosses 7 lakh rupees, then 0.5% TCS is applicable to this particular transaction. This is a new change introduced by Finance Act 2020. Similarly, sale of goods. If the aggregate amount of sale of goods exceeds 50 lakh rupees, there is a TCS applicable to the extent of 0.5% of the sale consideration. 0.5% of the sale consideration is the TCS that is applicable in case the sale consideration exceeds 50 lakh rupees. Um, I'm sorry, I think the rate of TCS is not 0.5, it is 0.1%. Okay. 0.1% is applicable in case the consideration exceeds rupees 50 lakh. This is applicable with effect from 1st October 2020. The sale of goods TCS is applicable from 1st October 2020 and it is 0.1% and not 0.5%. The last of my slides talk about the last chapter at the CA intermediate level. The last chapter would be filing of returns of income. One small change has taken place here. The due date for filing return of income, which usually used to be different, is now this. 31st October in case audit of books of account is applicable. 30th November in case audit is applicable under section 92E, and 31st July in all other cases. I'll repeat, 31st October of the assessment year if you are a company or a person who is required to get books of accounts audited or partner of a firm whose books of accounts are required to be audited. 30th November if you are required to furnish report in section 92E, that's for arm's length pricing, and 31st July in all other cases. So if no audit is required, if you are not a company, no audit is required, if 92E is not applicable, just an individual or HF either not having business income or having business income on which audits are not applicable, then 31st July of the assessment year will be the due date for filing returns of income. The change that has taken place here is that one is the dates, 31st October, which was previously 30th September. The second one is that previously, if you are a working partner in a firm where books of accounts are required to be audited, then only the due date, the extended due date of 31st October, before it was 30th September, was applicable. Now they have removed that working partner thing. Now they have told partner of a firm whose books of accounts are required to be audited, the due date is going to be 31st October, which means whether you are a working partner or a sleeping partner, if the books of accounts of your firm are required to be audited, then the due date is going to be 31st October. So these are the changes that I wanted to discuss. I will very quickly in the next 2 minutes, wrap up the amendments that have happened here. I will go back to the initial screen that I had shown. So these are some of the amendments that have taken place. Chapter wise at the CA intermediate stage, basic concept, there are no amendments. The rule of residence and the scope of total income, there is a change in there is an amendment in the definition of resident. And we have discussed on that. The 120-day rule has been added. At the salaries, there is a change under section 17, wherein they have said that contribution to a recognized provident fund, superannuation fund, or NPS under section 80CCD by the employer, if it exceeds a certain amount, then it is chargeable to tax. Business of profession, section 35, weighted deductions are abolished. 44AB, 5% of cash receipts, 5% of cash payments for turnover not exceeding 5 crore has been introduced. Capital gain under section 50C, the margin now is 110% of the consideration for the stamp duty value for it to be applicable. Otherwise, if it is within 110%, then it is not applicable. 55, if the capital asset is acquired before 1/4/2001, stamp duty value of the immovable property as of 1/4/2001 will be the fair market value. Income from other sources, very importantly, dividends are now chargeable to tax. Deduction is limited to interest expenditure incurred in earning the dividend, which cannot exceed 20% of the dividend income. Deductions from gross total income, 80EEA, even if the loan is taken in 2021, is applicable. 80GGA cash donations are applicable, are deductible only if they don't exceed to 2,000 rupees. 115 BAC, we have discussed enough of this. Alternate mode of taxation, new scheme of taxation that is applicable, requesting the students again and again to be well versed under 100 on section 115 BAC. Advanced tax, TDS, TCS. These are the deductions. These are the changes that have taken place. The list of sections are given to you. Very, very, very importantly, 75% of the rate that is applicable. 75% of the rate that is applicable in case the deduction or collection happens between 14th May 2020 and 31st March 2021. Returns of income, we have seen the due date is now 31st October, and it is even applicable to a sleeping partner of a firm whose books of accounts are required to be audited. The extended due date is applicable. So with this, I think we can look if there are any questions that are asked in the chat window. We can answer the questions. I would request the technical team, in case there are questions that are asked in the chat window, to please bring it on the screen so that I can check. Someone has asked, what about the old provisions under Section 44AB? The older provisions are still applicable. Older provisions are still applicable. Please remember, an addition is being introduced. The 5% of cash receipts not exceeding 5% of the total receipts, cash payments not exceeding 5% of the total payment, if the turnover does not exceed 5 crore, is an additional condition under Section 44AB. So I think that's the only question that has been asked there in the chat window. I think with this, we can call it a day. I once again would like to thank the management and staff of Trisha classes for giving me an opportunity to interact with the students on sharing the updates in income tax that are applicable for May 2021 exams. These amendments are also applicable to November 2021 exams. I wish all the students who are watching this telecast, yeah, there is one more question that has been asked here. In exam, while calculating tax, whether required to, I think, apply both the scheme, whether required to calculate in both the method. The question is, in exam, while calculating tax, whether required to calculate in both the method. Yes, Pritam Pujari, yes. Whenever the problem asks you to calculate tax, if the SSE is an individual or an HUF, you are supposed to calculate tax under both the schemes and make a conclusion of your own on which is beneficial to the individual or the HUF SSE. By default, this should be the line of thinking of, forget students, even a practicing professional. Whenever there is an individual that is involved or an HUF SSE that is involved, if the problem asks you to calculate income and calculate tax thereon, even calculation of income, remember under 115 BAC, it will be a different income with a number of exemptions and deductions being struck off. So the moment the problem asks you to calculate income and the tax thereon, you have to calculate it under both the methods and give a suggestion to the SSE as to which one is beneficial. Yes, this multiplies the time available for answering the question, but I'm pretty sure the examiner would consider this and ask questions. Maybe the question will be framed in such a manner that they will ask you to calculate income and tax only under 115 BAC, only under old scheme of taxation. If the problem says calculate income and tax thereon only under 115 BAC, then it's very easy. It's very clear that you have to only calculate it considering the provisions of 115 BAC. But if the problem is silent, it only asks you to calculate income and tax, then I'm afraid, my dear friend, you have to calculate incomes under both the method, calculate taxes under both the method. So I think that should be it. I think thank you very much once again to everyone concerned, including the technical person standing here, for arranging everything in time and ensuring that the session goes on smoothly. Thanks very much, and back to you.